Welcome to the TEK2day podcast powered by CEO Radar. It's your host, John Mayetta. Rate your company, rate your CEO at CEO Radar. I just had a conversation a couple days ago with a friend of mine saying, hey, you can't own anything in this current market other than make a bet on management teams. Happy to help. That's why we're here. You know, if you know me, I've mentioned in the past that in my sell-side days, I used to pick up coverage. Quality management team was a primary filter. In my M&A days, quality of the target company, quality of the management team was the primary filter within the spaces I used to look at. And the CEO Radar's reason for existence is to help institutional investors, boards, executive recruiters identify quality CEOs, employees. That's the whole rationale behind our crowdsourced platform. And I promise we will eventually get to a proprietary CEO score. Right now it's available as a consulting service. It's not yet baked into the platform. So self-service is not yet an option, but it will be. So I continue to be pessimistic on the economy. You can read about it at TEK2day. We published an article this evening entitled "The V Recovery is Not in the Cards." Let me just walk you through. So some of the inputs as to why I'm negative in the economy. Even though the market has had sort of a V recovery, which I expect to reverse itself, the economy certainly has not and will not, in my opinion. So the inputs. PPP, Fed liquidity will eventually expire. So I think you're going to see more liquidity. I think you'll likely see another airline bailout in the fall when the current stimulus expires in September. I think you'll probably see a forced merger in the airlines. Maybe even a bankruptcy, and the feds will own a portion of the airlines, maybe at some point even nationalize the airlines. But at some point, barring even with future stimulus, at some point this masking effect that federal liquidity has had on the markets will dissipate, and it's not going to matter. At some point, the liquidity that the federal government has injected in the economy isn't going to matter. I feel like the stimulus program in many cases has just delayed the inevitable. Good money after bad going into businesses that were on their way out anyway. Small restaurants that were being ground into the ground, ground into non-existence by regional chains who were taking share. They were going the way of the dodo anyway. Retailers that hadn't successfully transitioned to e-commerce were going the way of the dinosaurs anyway. Commercial property owners whose anchor tenants were retailers that were going out of business anyway. They themselves were going out of business. So this thing's going to have a domino effect. Right? We have this phased-in approach, phased-in reopening approach to the economy. And we wrote about that last week where many cities and towns are operating at 10, 20, 30% capacity, restaurants operating at 10, 20, 30% occupancy. It's going to be difficult for many of these small businesses to remain solvent at those occupancy levels. And even if we flip the switch, remove the restrictions, and go to 100% occupancy tomorrow, I'm not sure that customers are going to come back certainly not at the same levels as back in December, January. And I'm not sure that customers will immediately return at a level that's going to allow many of these small businesses to remain solvent. So I think you're going to have a number of defaults and bankruptcies amongst small restaurants, hotels, motels, commercial property owners whose tenants are these small businesses. I think the restaurants and the small businesses themselves, you'll start to see news of those defaults and bankruptcies first. And it will then have an impact on the commercial real estate owners. That'll be a bit of a lagged effect. But you're already seeing weakness now in commercial real estate. Transactions have essentially halted. Price discovery hasn't occurred. Sellers still want pre-COVID valuations, and buyers want some number that's substantially lower. And my bet is that as the fundamentals remain soft, the seller is going to find religion before buyers acquiesce. So we had Jones Lang report last night. We have CBRE tomorrow. We've seen softness in CoStar's bookings for a couple of quarters. So it's happening. So we covered liquidity, covered retail, hospitality, small business, property owners. The other one that may not seem intuitive, that may not seem obvious, but the subject of operating efficiency, which is typically a good thing. In the short term, it's going to be bad news for jobs, because if you think about companies that lived through the 2008 downturn, particularly if the same CEO and CFO team is in place, those companies learn how to get lean and run a lean business. And maybe they relaxed the operating purse strings a bit since '08. But those companies that lived through the '08-'09 crisis are still, for the most part, running lean operations. And so they know how to navigate these choppy waters. And those companies are less likely to have significant employee rifts. Then if you think about companies that did not have the benefit of the 2008-2009 downturn experience, if you think about late-stage, bloated, venture-backed companies whose directive from the board was to grow at all costs, don't worry about profitability, burn cash, hire as many salespeople as it takes, grow at all costs so that we can jack up the valuation. You're seeing all sorts of layoffs there within tech, which are traditionally very durable business models. You've seen the layoffs in the airlines, obviously, but that's more of a structural thing. But I'm speaking more about companies that are now getting religion around operating efficiency, that have had to lay people off. And what many will realize, if they haven't already, is that, hey, we can run the business a lot leaner and not lose productivity. And that lesson will be driven home further as this recovery takes place. It feels like we've stabilized a bit. I would expect very, very modest activity, economic activity, to take place in Q3. Very, very modest recovery in Q4. And as things rebound very slowly, companies are going to realize, hey, we could operate the business with a lot less expense. So that means a lot of the people that were laid off aren't going to get rehired. So if you think about all the different bullets that I've talked about, you're likely to see a lot more rifts around airlines, hotels, motels, hospitality sector in general. Commercial real estate starts are likely to slow and are already slowing. So that means layoffs in the construction sector. And again, as I believe many of the people that have been laid off aren't going to have a job to go back to and aren't going to have a business to go back to if their employer is gone insolvent. So I think when you listen to people like the president of the St. Louis Fed, who believe that in Q4 we're almost going to be back to normal from an activity level, and that you'll see unemployment well on its way back to normal, I just don't think that's the case. I think unemployment levels are going to remain high. I think low double digits at best. 10% is a best case scenario for unemployment at year end. And that's the reason why you're not going to have a V-shaped economic recovery. There's going to be far too many people out of work. You've got people buying Peloton bikes. I mean, do you really think that's going to continue? Hey, people can't go out, so they're buying bikes for the house. Do you really think that's going to continue when the big unemployment numbers hit soon? When people see how bad Q2 is in the Q2 earnings reports. I believe when the Q2 earnings reports, when those prints hit, that those analysts who are proponents of a V economic recovery, their confidence is going to be tested. We'll see the strength of their convictions then. My bet is that the analyst community is going to bring down Q3 estimates when the Q2 prints hit. For sure, they're going to bring down the Q4 estimates, that hockey stick recovery that I saw so many people model coming off of the Q1 earnings calls. Those Q4 estimates are going to be reduced. For sure. And when those Q4 estimates are reduced, I can promise you the 2021 calendar estimate's going to be reduced. So I think a lot of the bulls are going to get religion really quickly this summer, around the time of the Q2 earnings calls. So mark your calendars for July. That's all for now. See you next time.